Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Maximizing Gains, your guide to long-term CD investment strategies. Tax implications and considerations. When it comes to long-term certificates of deposit, CDs, understanding the tax implications and considerations is crucial for maximizing your investment returns. Here's what you need to know. Taxable interest income. One key consideration with CDs is the interest income they generate. The interest earned on CDs is considered taxable income by the IRS, which means you'll need to report it on your annual tax return. It's important to keep track of this income and ensure accurate reporting to avoid any tax issues. Early withdrawal penalties. Another tax consideration with CDs is early withdrawals. If you need to withdraw funds from a CD before its maturity date, you may be subject to early withdrawal penalties. These penalties can impact your overall return on investment and should be taken into account when planning your finances. Tax-advantaged accounts. To mitigate tax implications on CD earnings, consider investing in tax-advantaged accounts like an individual retirement account (IRA) or a 401k. By holding CDs within these accounts, you can potentially defer taxes on the interest earned until you make withdrawals during retirement. Tax withholding. In some cases, financial institutions may withhold taxes on CD interest at the time it's credited to your account. This withholding is done to ensure tax compliance and may affect the amount of interest you actually receive. Be aware of any tax withholding policies that apply to your CDs. Consult with a tax professional. Given the complexity of tax implications related to investments, including CDs, it's advisable to consult with a tax professional. A tax advisor can provide personalized guidance based on your financial situation and help you navigate any potential tax issues that may arise with your CD investments. Managing risks associated with long-term CDS. Long-term certificates of deposit, CDs, can be valuable investment tools, but they come with their own set of risks that investors need to be aware of and manage effectively. Two key risks associated with long-term CDs are interest rate risk and liquidity risk. Interest rate risk. Interest rate risk is a significant concern when investing in long-term CDs. This risk arises from the potential changes in interest rates over the life of the CD. If interest rates rise after you've locked in a long-term CD at a lower rate, you may miss out on the opportunity to earn higher returns elsewhere. On the other hand, if interest rates drop, you benefit from having locked in a higher rate. To manage interest rate risk, consider building a CD ladder where you stagger your investments across multiple CDs with varying maturity dates. This strategy allows you to reinvest at higher rates as each CD matures. Liquidity risk. Liquidity risk refers to the inability to access your funds when you need them without incurring penalties. Long-term CDs typically have fixed maturity dates, so withdrawing funds before the CD matures can result in substantial penalties. To mitigate liquidity risk, only invest funds in long-term CDs that you can afford to lock away for the entire duration of the investment. Consider keeping a portion of your investment in more liquid assets to cover any unexpected expenses or emergencies without the need to break your CD prematurely. By understanding and actively managing these risks associated with long-term CDs, you can make informed investment decisions that align with your financial goals and risk tolerance. It's crucial to assess your risk appetite and financial needs before committing to long-term CD investments to ensure they are a suitable addition to your investment portfolio. Alternatives to long-term CDS. When considering alternatives to long-term CDs, it's essential to weigh the benefits and drawbacks of various options to make an informed decision that aligns with your financial goals. Short-term CDS vs. long-term CDS. Short-term CDs offer the advantage of quicker access to your funds compared to long-term CDs. If you anticipate needing your money in the near future or want to take advantage of potentially higher interest rates sooner, a short-term CD may be a better fit. On the other hand, long-term CDs typically offer higher interest rates, providing the opportunity for greater returns over an extended period. Consider your financial objectives and timeline to determine whether a short-term or long-term CD best suits your needs. Other investment options. 1. High-yield savings accounts. High-yield savings accounts provide a flexible alternative to CDs, offering competitive interest rates while allowing you to access your funds without penalty. 1. They can be a suitable choice for those seeking a balance between growth potential and liquidity. 1. Stock market investments. Investing in stocks can offer the potential for higher returns compared to CDs, albeit with increased risk. 1. Diversifying your portfolio with stock market investments can help maximize growth opportunities over the long term. 1. Bonds. Bonds can provide a fixed income stream and are generally considered less risky than stocks. 1. Treasury bonds, municipal bonds, or corporate bonds offer investors different options based on risk tolerance and investment objectives. 1. Real estate. Investing in real estate can yield rental income and property appreciation. 1. Real estate investments can diversify your portfolio and serve as a long-term asset with the potential for passive income. 1. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. 1. They offer professional management and diversification, making them a convenient option for investors seeking a hands-off approach. As you explore alternatives to long-term CDs, it's crucial to assess your risk tolerance, investment timeline, and financial objectives to build a well-rounded investment strategy that aligns with your unique financial situation. Each option comes with its own set of considerations, so researching and consulting with a financial advisor can help you make informed decisions tailored to your specific needs and goals. Tips for success with long-term CDS. Long-term certificates of deposit, CDs, can be a valuable tool for growing your savings over time. To make the most of your long-term CD investments, consider the following tips. Regularly review and adjust. When investing in long-term CDs, it's important to regularly review your financial goals and assess whether your current CD still aligns with those goals. Interest rates and market conditions can change, impacting the performance of your CD. By reviewing your investments periodically, you can ensure that your money is working as hard as possible for you. Diversify your portfolio. Diversification is a key strategy to manage risk and maximize returns. While long-term CDs offer stability and fixed returns, it's also important to consider diversifying your investment portfolio with other assets such as stocks, bonds, and mutual funds. By spreading your investments across different asset classes, you can reduce the impact of market fluctuations on your overall wealth. By following these tips and staying informed about market trends, you can set yourself up for success with your long-term CD investments. In closing, long-term certificates of deposit can be a smart choice for those looking to grow their savings steadily over time. By locking in your funds for a set period, you can benefit from higher interest rates compared to regular savings accounts. This low-risk investment option provides a stable way to watch your money grow without the volatility of the stock market. Consider your financial goals and timeline when deciding if a long-term certificate of deposit is right for you. Remember, patience is key when it comes to long-term investing. So, weigh your options, do your research, and make a decision that aligns with your financial strategy. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.